Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Monday, May 19th, 2025. Today's episode begins bringing up the leading economic indicators. Came out today, still tanking, while the stock market, credit spreads, Bitcoin, fartcoin, you name it, are just screaming complacency, just very, very confident about the future. There's a thing called the leading economic index, which is continuing to absolutely collapse. You know, it was a few months ago where it looks like it may have been at least getting to a point where we were going sideways. We are just falling off of a cliff here. Just as a quick reminder, this blue line is the LEI, the Conference Board Leading Economic Index, and when this falls, the coincident index typically follows soon after every single time, like clockwork. And when the black line falls, that's when there really is a recession happening, because it's not the leading information that is saying things are falling apart. It's the, real hard data that is saying, yeah, stuff's hitting the fan. And in this report, it says weakness across nearly all of the LEI's 10 components fueled April's decline. Most notably, the S&P 500 being part of the financial components, and then the biggest of the non-financial are the average consumer expectations for business conditions. And then again, just like last month, the ISM New Orders Index, pretty weak. And then also building permits, private housing, negative 0.14, and average weekly hours, all of them were basically negative. The conference board also shows a little bit when you scroll down on their page on their website. The LEI's 6-month growth rate declined further in April, but still remained slightly above recession signal threshold. The threshold being this black and red dotted line right here. Notably, we're so close to it that you can't even see it on this chart. We are sitting on it right now. If the trend continues in May, it will most definitely be triggering the recession signal that they have set up here on this chart. If the LEI was not still tanking and going sideways or bouncing up a little bit, it may give a little bit of legs or reason for Mr. Market to be like, hey, everything's going to be all right. But it is not showing that, quite the opposite right now. And along with that, generally complacency everywhere. Finally, Jamie Dimon is joining my parade, saying markets are too complacent on tariffs, expects the S&P 500 earnings growth to collapse. Now, I think the tariffs thing is actually a very smaller piece of the puzzle. Living through all of this, what's going on with markets, what has been going on with markets, before the tariffs were even like something that anyone was even thinking of, things were set to collapse here, and the tariffs just kind of, for me, it's the last straw on that breaks the camel's back, as they say. But welcome to the party, Jamie Dimon. There's some interesting things going on in the charts, especially regarding the reaction to the Moody's downgrade, which we'll talk about when we get to the charts. Before that, community topics. What moves, if any, did you make today? Robschild sold KWEB. I said on Friday that I was selling my CWEB, leveraged form of KWEB, along with Alibaba stock to help reduce my allocation to China. It was still at 13% as of this morning, so I sold enough of it to get it down to a 10% allocation, which was my goal initially. And since it's been going up and my bonds have been going down, I took that down. And while bonds are, were lower than ever this morning, I was able to get some TMF at a very low price. This is basically TLT on, let's call it, leverage. Coming up, as always, continuous tariff updates, and also the federal budget has not been released yet, and that's a big one. This, it really will tell if we are going to be cutting enough spending to really help this inflation continue down and to allow the Fed to perhaps think more strongly about cutting rates, or is, the plan of the U.S. government to just spend, twice as much as we did last year. It's a very important report, and we're not really. My understanding is normally by this time in the year we have the budget basically set for the next year, and we don't have it yet. And so hopefully that comes in soon. And that's something very important to look forward to. I'm going to add that to the coming up section. So there you have it. Federal budget. That's another thing, a big thing that really you need to look out for, that can really rock rates around, rock everything around. And then, of course, on Thursday, initial continuing claims. Like I keep saying, this is one of the real big hard data pieces that once this starts going up and up and up, which it hasn't yet, that's like, okay, now we know for sure that the recession is starting, and it hasn't happened yet. This comes out every week, and it is important to check under a microscope every week, in my strong estimation, on Thursdays when it comes out. As always, thank you for watching, subscribing, commenting, and supporting. The subscription buttons over here. The support information is here, also in the description. Thank you for all your support. No changes in the daily reminders, macro views. Click the link in the description to read my explanations. And as I said in the beginning of the show, a few little updates to the Robschild portfolio. Reducing China exposure, adding long duration exposure via TMF. Other than that, no major changes, and no major changes to the crystal ball ratings. On to the charts. The S&P 500 opened about let's say 0.7%, I think, lower than Friday's close. However, during the day, the bulls just carried it higher, and we engulfed this entire candle. My perspective on this is there's a lot of strength there. The bulls somehow managed to have a lot of strength today, despite the Moody's downgrade. Like I said in my special over the weekend, typically, the past two times we had this, the stock market, it went down. It didn't go up. So very interesting to have this happen specifically today, ending the day about 0.1% higher than Friday's close. Next, TLT, my favorite place to be. I was able to buy TMF when it was down in this range over the course of the day. You get a downgrade of the U.S. debt, so the U.S. debt value should go down and yields should go up, right? Well, they did briefly, and then it reversed. Can you believe it? We still ended, minus 0.3% from Friday's close, but the bond bulls came in here, or maybe this was a bit of a short squeeze. People that were short, I do understand there was a lot of shorting going on in the bond market, so this could just be shorts like getting out, especially as it's like climbing and people are like, oh, it can get people to jump out of their shorts and cause it to go higher and higher. One thing I wanted to add about the TLT is that, I've been talking about for a while this gap fill zone back from January 2025, how we needed to see a fight zone. We've fought enough in here that now we can break out of here, and I would think it would go up, but it can go down just from a chart pattern perspective. I'm not sure how sustainable yields are this high, but I just also want to stretch this gap fill out. If I pull these lines all the way back here, there's a massive gap fill that went all the way back to October of 2023 back here. I didn't even realize this until I just recently scrolled out on this chart. So this is a strong zone with two big gap fills. Gaps here in the charts. This is a zone where there needs to be a battle royale, as they say. I would not be at all surprised to see us continue to fight in this zone for a little while here, but that's just a chart pattern thing. One of the additional reasons I'm excited about getting into TMF, a leveraged form of TLT, the 30-year Treasury bond yield on the opening today was higher than it's been since October of 2023 when we got to this ultimate high. And previously, we hadn't seen yields in the 30-year bond yield that high since 2007. Can you believe it? We haven't seen yields that high for that long. And so, in my book, this counts as potentially an opportunity that may prove to be potentially one of the best opportunities of decades at this point, the way that I'm seeing it. I've been talking about on the show about rates potentially getting all the way back down to zero and maybe even negative, but I'm not betting on that. I am looking more for around the 3.5% range, which is where I think that it can go to very easily. And then beyond there, I think it will go lower, but not confident enough to hold on to Treasury bonds at a lower yield than that. So I just wanted to include that as part of my exit plan here. Anyhow, with TLT dropping by only 0.3%, it's always good to check what's going on with the MOVE index. This is basically the VIX, but of bonds, and it actually spiked today. So this is starting to look like maybe we're having some kind of bottom here. This, we no longer have very clear. I mean, look at before. It was lower high, lower high, lower high, lower high. Now it's a higher high, all lower lows. So now we're setting ourselves up for either some kind of sideways thing or potentially reversing course and going to the upside, which can indicate actually bonds going up violently, not just down, especially if stock markets crash and money flows into bonds, as it often does in those situations. It could end up panning out that way in the near term. I'm not really sure right now. Next, I want to bring up HYG divided by SHI just to say, yes, credit spreads are back to very, very tight. This is complacency. Money is just like seeking return. Like, where can I get the most return? Like, what's going to be going up next? Just like, that's the feeling going on here. Next, I wanted to mention Bitcoin having a very interesting day. If you were watching it during the day and saw it engulf this entire green candle, you would have been very surprised because of this very clear like bull flag thing and then breaking out. It looks like this thing just was going to go higher and higher and higher, and then engulfing to the downside the whole candle was very surprising. And now it's actually looking more bullish than anything at the moment. With the Moody downgrade of US debt, it's always good to check what's going on with the dollar. So the dollar did drop, but not by all that much, by 0.6%. Like I said, for the financial market update video that I did, the Moody's downgrade, you might be able to see it more as a lagging indicator than a leading one. It doesn't apparently have as much weight as some of us imagined. It's kind of more, it's acting more reactionary. If it wasn't, then we would see the markets reacting more to it after the fact, and we're not. And we can see this, especially across commodities with crude oil is completely sideways right now. Also, copper, just sideways. After all this violent movement, just winding up here, obviously preparing for a bigger move, either up or down, but right now just completely sideways. Even gold starting to wind up here, having lower highs and higher lows at the same time. I want to note as I've been noting for the past 5 trading days, the Russell 2000 still not able to really confirm a higher high. So much resistance here. Plenty of sellers willing to get out before, assumably, they think, along with myself, that this may head down to lower lows. Another little chart I wanted to bring up today was XLU. This is an ETF of the utilities. And just because we're basically at all-time highs right now in utilities, and utilities is kind of a funny thing because they do act as a sector that is defensive. It's the kind of thing that you want to invest in to protect yourself from downside. However, you can say that, but you scroll out on the chart, you go back down, to the great financial crisis. From peak to trough, this thing lost 50% along with the rest of the market. And then in the dot-com bust, it actually lost more than that. In 2000 to 2002, it lost 56%, believe it or not. So while it's a pretty decent hedge against inflation, it's not that great of a protection against stock market, a bear stock market, for example, or a recession. Next chart I want to bring up today, which I think is getting to a very important point, is the put to call ratio. This is how much are people betting that the market is going to crash here? Not many. In fact, this is close to the lowest amount of bears on puts that we've seen over the past 3 years. I mean, this blue line is the put to call ratio, and the only time we saw it lower than this was January 31st of 2025. I want to note that when this typically gets to a bottom, look at what the orange line is, the S&P 500. What happens to the S&P 500? It goes down. When you kill all the bears and no one has put contracts on the S&P 500, that, like I've said on the show many times, in order for the market to get bearish, sometimes you have to kill all the bears first. And this is exactly what we're seeing here. And over again, the put to call ratio, all-time low within this range, well, sort of. You see right here what happens to the S&P 500 from that point. Drops. That was July 28th of 2023 to October of 2023. Again, bottom right here in July of 2024. What happens to stocks? They drop. And then what happened, soon after the low of this entire chart in January 30th, 2025, when the put call ratio was only 0.76. Soon after, the S&P 500 dropped over 20% right there. So we're back into this zone of extreme low put to call ratio, which, again, this means the market can, the institutions can let the market fall now that nobody has any puts. We killed all the bears, so now the market can get bearish. So it's probably one of the best times to actually have puts right now on the S&P 500 when nobody wants them anymore. It's just so funny how that works. With the downgrade of U.S. debt from Moody's, maybe the break-even inflation rate might see like, inflation's getting out of control. No, in fact, we didn't get above May 14th's high since May 14th. So I find that to be interesting in the 10-year break-even inflation rate. I know I've brought this chart up before, and I will be repeating myself ad nauseum. The gold to oil ratio is ridiculous right now, guys. I've said it on numerous shows before. It costs 1 ounce of gold to buy 56 barrels of oil. Gold has never been more expensive to the price of oil, except for, when oil was negative $37 a barrel in 2020. Yeah, gold bought you more barrels of oil then. It bought you infinite amounts of oil at that point because the price of oil was briefly negative. But besides that, gold's never been more expensive to oil. if gold's not in a bubble right now, I'll eat my own hat. Last chart of the day, UNH. I talked about why I bought this stock recently in a recent video, and it was at the point when I bought it, it was about a 20% discount to the 25 PE ratio of the past 10 years of average earnings. And that price is around $333. And I'm very surprised to see how quickly we're getting back to that target. I'll actually be selling this if we get to $333 in the near term. If we get lower, I will be accumulating more of this stock. For a company that's this big and, I mean, this solid and this able to generate earnings, a 20% discount to average PE of 25 of the past 10 years of average earnings is like a great opportunity. But like above that, like, no, I'm not interested in playing games. I stick to conservative valuations, as I learned from Benjamin Graham himself. And that's all for today's show. That's all for me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.